All right, guys, a short money market review, or at least as short as I can make it. The money market is one of the probably big 5 models that you're going to see in AP Macro. And this one is also called the liquidity preference model. And understanding this is going to help you understand this model a little bit more and help you differentiate it from the loanable funds market. Because there is a little confusion and like what kind of overlap there is between the two and what really separates the two. So the big difference here is this one is about the demand to hold cash or liquid money. So when we look at this demand curve, and I'll emphasize this again once more, but when we're looking at this demand curve, it's not a demand for loans, it's a demand to hold money, to actually have cash or liquid money available to you. All right, so we'll talk about what changes that. Another big thing about this one is it's short run. Loanable funds is more long run kind of stuff. This one's short run, it's nominal interest rates. So it deals with the nominal, and the federal funds rate is closely tied to this, because when the Federal Reserve is making decisions, their goal is usually to impact the federal funds rate. So this one is tied more to this model right here. Now, finally, we have the vertical supply curve, the money supply curve. This is determined by the Federal Reserve and solely by the Federal Reserve. Their monetary policy is going to shift this curve to the left and to the right. So that's the big differences between this one and loanable funds. So just keep that in mind as we're going through this stuff. All right, a couple terms I want to cover before we get going. Money aggregates. These are the different measurements of money. We're going to M0, M1, and M2. And these are all based on how liquid they are. Liquidity is how quickly assets can be converted into cash and not losing, value in the process. M0 is our monetary base. This is the actual cash, the currency that exists, the coins and the cash. M1 is all the cash, traveler's checks, which really aren't too big of a deal anymore, and then all the demand deposits or the checkable deposits that people can get access to really quickly. It's not quite as liquid as cash, but we can basically spend our checking accounts anywhere. We can ATM machine, we can pull money out. You can use your debit card at places. This money is not as easy accessible as cash, but it's not much further off. Now, M2 is one step further, one step less liquid, where it's everything from M1 plus savings deposits, and then certificates of deposits or CDs and other time deposits. Now, these accounts usually have a little more restrictions. You can only take out so much per year. You can, if you're going to lose the interest that you've earned if you take it out before a certain time. So it's a little less liquid in terms of having access to it. So there's some more restrictions with it. So these are the 3. There was an M3 at one time, but they're still there, but they don't use it as much. All right, so money demand. All right, when we look at the money demand, it's the demand to hold money. All right, the demand curve doesn't represent what we want to borrow, it's what we want to keep in our pockets. All right, guys, so why hold cash? Why would you even want to have cash in your wallet, besides a little amount? But some people want to keep it for transaction reasons, just everyday purchases, have cash around to maybe pay the pizza guy, maybe to pay for groceries. It's a changing time, but cash is still relevant in the world. So the more stuff you buy, the more cash you're going to hold. Emergencies, just in case. Maybe you're going to see that great deal. The guy next door is going to sell something to you, or maybe your car's broken down and you need to pay somebody cash. So just in an emergency, people like to have cash around. Now, finally, speculation. Having cash or near cash real close to it is always a good idea, because you might just walk into that perfect deal, that perfect opportunity, that perfect investment. So it's better to have cash or close to it, and be prepared to buy those assets if all of a sudden something changes. So transactions, emergency, and speculations are the reasons why people hold cash. Now, why not hold cash? All right, why would you want to put it somewhere else besides keep it? All right, and that's the opportunity cost. Every time I put cash in my wallet, every time I keep cash under my mattress, every time I keep cash in a vault at home, I'm losing the interest that the bank could be paying me. When we put money in savings accounts, we're getting paid interest. So the lower the interest rate, as the interest rate goes down, there's a greater desire to hold money in my pocket. If I'm getting 3% interest, I'm more likely to hold money on me than I am when it's at 5%. As the interest rate goes up, the opportunity cost of holding money gets higher. So I'm willing to hold less at higher interest rates. I'm willing to hold more at lower interest rates. All right, so that explains the demand for money. let's talk about why the demand would change entirely, like the entire curve shifting. So a money demand increase is going to shift the entire money demand curve, either up or down. So some things that will shift this money demand up cause nominal interest rates to increase as well. Price level increase. If prices go up across the board, I'm going to need more money to keep for my everyday purchases. If income increases, I'm going to be spending more money, so I'm going to keep more on me. Likewise, if GDP increases, we know that real incomes are going to go up, so a GDP increase would cause money demand to go up as well, and in turn cause the interest rates to go up. Now finally, institution changes. Interest paid on checkable deposits. Now this is one thing where a lot of people were keeping money in savings accounts. This is prior to 1980 because there was a big change at that point. People were keeping money in savings because it was paying interest when checking deposits were not paying interest. So people started to change where their money was, because when checking accounts started getting paid interest for keeping your money there, people shifted their money out of savings accounts and wanted it more in liquid cash or close to liquid cash. So that would increase the money demand as well. So price level increases, income increases, and then institution changes within the banking system itself. All right, money demand decreases. This is going to cause the money demand curve to go down, and if nothing else changes, it's going to bring interest rates, nominal interest rates, down as well. All right, a price level decrease. If prices go down across the board, people are going to need to keep less money in their hands to make the purchases that they need. If income goes down, people are going to hold less money. Likewise, if GDP goes down, real incomes go down, so that's one and the same. Institution changes. The widespread use of credit cards. As banks started offering more and more credit cards, people could make the purchases, the everyday purchases with those, and they needed to carry less cash on them. So in an emergency, they could use a credit card. They could buy their groceries with a credit card. They could pay the pizza man with a credit card, and it caused the demand for money to go down. Now finally, technology. And this is something that in most of your lifetimes, you haven't seen anything different. ATMs available everywhere, PayPal, Venmo. There's so many different ways to pay for your goods that you don't need access to cash for. So it brings that money supply or money demand down. All right, because I can get access to everything so quickly, I can transfer funds so easily, the money demand goes down. I don't have to hold as much cash in my hands. All right, now the money supply is all determined by the Federal Reserve. That's why it's that vertical line. So it's only impacted by the Federal Reserve and their monetary policy. So there are three tools: the reserve requirements, the discount rate, and then their open market operations. When they make these changes, they're usually targeting a federal funds rate, that rate that banks make short-term loans to each other to kind of cover their reserve requirements. So they target that federal funds rate, and we see this money supply curve shift to the right when it increases and shift to the left when it decreases. Now let's see what causes these increases and decreases. So an increase in the money supply can be caused by the three different tools that the Federal Reserve can use: a decrease in the reserve requirement, a decrease in the discount rate, and then buying government bonds or buying government treasuries. All three of these would increase the money supply and shift that money supply to the right, dropping the interest rate down, and this would have an effect on aggregate demand. This would have an effect on, real interest rates. So it's going to have some after effects, but this is the initial change. Increase in the money supply, for whatever reason, is going to drop interest rates because the money supply shifts to the right. Now, a decrease in the money supply is going to be caused by the same things, just as in the opposite direction. You have an increase in the reserve requirement, banks can loan less out, money supply goes down. Increase in the discount rate, and also selling government bonds, that open market operation. All three of these would decrease the money supply and shift that money supply back to the left, bringing interest rates up. That increase in interest rate would curb aggregate demand, investment, and interest-sensitive consumption, and have after effects after that as well. But decrease in the money supply, interest rates up, nominal interest rates up. All right, now, one more thing to cover before we're done. Nominal interest rates affect what? So it will affect investment spending, it will affect interest-sensitive consumption, and then also aggregate demand because of these two. It will also affect real interest rates, not because we're dealing with loanable funds markets here, but because of nominal interest rates minus inflation are going to give us our real interest rates. Anytime we change the nominal interest rates, everything else is going to be affected. The real interest rate will be affected too. So these are just the things that can be impacted by the money market changes. whether it's aggregate or whether it's money demand changing or money supply changing, these can be the things that are impacted by it. All right, hopefully you guys got something from that. I hope you guys take a look at my FRQ walkthroughs. If you wanted more stuff on the money market, questions 2017 number 2 and 2009 number 1 are excellent places to look for money market type concepts. 2017 number 2 is all about the money markets. 2009 is a big part of it. So hopefully you guys enjoyed this. Thanks for taking a look, and I'll see you guys next time.